There's some really weird moves with currencies, with bonds. Markets are roiled. Bank of England had to step in, and people are supposing that's because there was the potential for markets to kind of fall apart, things to break. What do you think of this news this morning that Liz Truss and her government are not backing down with what they've already laid out?
I think she's giving a master class in how not to do it. If you step back, you say to yourself, inflation is running at about 9.9% in the UK, higher than here, really high. And so her first act is a sharp loosening of fiscal policy, which forces the Bank of England, as it itself said, first to tighten monetary policy further, offsetting what she did, and then the immediate loss of confidence was so sharp as a result of her move that the gilt market became essentially dysfunctional for a period of time last Friday. And the Bank of England then had no choice, because one of its mandates is financial market stability, to reverse itself on QE. We're not going to be selling our portfolio of gilts. We have to turn around and buy some for 5 weeks to stabilize the market, which is inherently contradictory relative to its long-term goal of inflation restraint, because that short-term step is inflationary. So it's just a big mess. And obviously, I saw some reference yesterday to the other party being 33 points ahead now. She's gotten off to a pretty bad start.
You know, you can say that central banks are the huge ocean freightliners. You better get out of their way. It's hard to fight against them, but the markets ultimately are the lighthouses. Like, you shift off course because the market is telling you you can't do this anymore. Who wins in this fight?
Well, I've rarely seen a period with so much uncertainty, and markets hate uncertainty, and I think everything taken into account, that's the main reason they're declining. So look at our side of the Atlantic. Right now, we are not in recession. You know, our firm does a lot of proprietary surveys, trucking surveys, airline surveys. They're really quite good. And they are not, they're softer, but they're not at recession levels. The goal for the Fed, of course, is to slow demand and thereby reduce inflation. But the point is, they're so far from achieving that because labor markets remain very tight, 3.7% unemployment rate, very tight. And we are such a long way from achieving the type of softness, for example, in labor markets that the Fed has to achieve to get inflation down. And so the $64,000 question is soft landing versus hard landing. My own view is the longer it takes to loosen up to make the economy softer, and particularly labor markets, the more likely we're going to have a hard landing. And I think every day that goes by, the hard landing chances go up.
We are living in global markets, though, and when you see this kind of turmoil and the British pound collapsing like this, when you see the pressure on the gilts market, we haven't seen any concerns about those trades here yet, and market stability here seems quite all right. But what are the risks that they are now posing to the rest of us?
I don't see any reason why we should see 2008 type instability in our own markets. I mean, as you know, there were 48-hour period in 2008 when markets really stopped functioning. There was a very brief moment right after COVID erupted when markets really stopped functioning too, and that's what the UK saw, as I understand it, last Friday in the gilt market. But I don't see why that should occur here. For example, the banking system here is not stressed the way it was in 2008. It's not at all stressed. Capital levels are, our buffer levels are very good, and I don't see any stresses in the financial system of the systemic type that would cause us to have those type of instabilities. I don't.